Welcome to the Deep Dive. Today we are cracking open the Dine Brands Global Q2 2025 earnings call. That's ticker DIN. It dropped pre-market back on August 6th.
Yeah, and this call, it really needs a deep dive. It was, a real mix. Strong revenue, some good operational stuff happening.
But the market reaction was pretty negative, wasn't it? Stock dropped almost immediately.
Exactly. Investors honed right in on profitability, or maybe the lack thereof, and the outlook.
So that's the puzzle we need to piece together for you today. We're going to unpack why management decided to make these big strategic investments now, even though it clearly caused, well, a rift with what the street wanted to see on the bottom line.
It's that classic tension, isn't it? Short-term results versus that longer-term strategic bet. Yeah. We need to understand the thinking behind their gamble.
Okay, let's ground ourselves first. Just a quick snapshot of the headline numbers.
Good idea. So revenue first.
Right. On revenue, it looked pretty good. Consolidated total revenues hit $230.8 million.
Which is up, almost 12% year over year?
Yeah, 11.9%.
Right.
And that comfortably beat the consensus estimates. So, that top line growth, it's definitely there. Traffic, check size, it's clicking.
But, and this is the big but, that strength didn't exactly flow through to the profit line. Adjusted EPS came in at $1.17.
Oof. That's quite a miss. Consensus was looking for something closer to like $1.45 to $1.49.
Exactly, a significant miss. And adjusted EBITDA, that felt pretty sharky too, down to $56.2 million.
Compared to $67 million last year, that's a big drop.
It is, about 16% down on profitability, even with revenue up nearly 12%. You can see why the market got nervous. That's the core issue right there.
And then you look at the brands individually, and it's a totally split picture. Applebee's actually did well. Positive domestic comps up 4.9%.
But IHOP lagged behind. Comps there were down 2.3%.
A real tale of two brands inside one company.
Well, it shows where the value message is resonating more strongly right now, doesn't it? The consumer's definitely feeling the pinch, looking for value.
Okay, let's dive into Applebee's first, because they seem to have found some real momentum.
Yeah, the big news there was traffic.
Positive traffic for the first time since, Q1 of 2023?
That's right. And not just positive. They actually beat the black box benchmark on both sales and traffic for the quarter. That's a strong signal.
So how are they doing it? What's driving that traffic?
Well, management was pretty clear. It's heavily driven by their everyday value platforms.
Ah, the value focus.
Yeah.
Like the 2 for $25, stuff like that.
Exactly. They leaned into that hard. The overall value mix at Applebee's was around 30% in Q2. Interestingly, it ticked down just a bit from Q1.
Which maybe suggests they're getting people in the door with value, but then successfully upselling them a bit. That barbell strategy.
Could be. And they're keeping that value tier fresh, which is smart. They mentioned introducing new entrees every quarter within that value menu.
Like the Bourbon Street Cajun pasta, chicken Parmesan fettuccine. Things that appeal to the core customer, but maybe bring in younger folks too.
Right. Keeps it from getting stale. And beyond the food, their marketing's seen a huge shift.
Oh yeah, they brought creative in-house, didn't they?
They did. And the results, at least on social media, are pretty staggering. TikTok views up over 500%, likes up nearly 1,000% in just 3 months.
Wow, that's huge engagement.
It shows they can be nimble, even as a big franchise system. And that digital buzz seems to be helping their off-premise business too.
Which makes sense. What were the off-premise numbers?
Applebee's off-premise sales saw a positive 7.6% lift in Q2.
Okay, so that digital connection is translating into actual takeout and delivery orders. That's a high margin channel. Got to keep that going.
Definitely. Now, switching gears to IHOP. If Applebee's is about acceleration, IHOP feels more like stabilization.
Okay. Comps were still negative, down 2.2%, but you said that was better than Q1.
Yeah, sequential improvement. And importantly, for the second quarter in a row, IHOP actually outperformed the black box traffic benchmark.
So even though overall sales are down, they're actually doing better than their direct competitors in terms of getting people through the door, gaining share.
Seems like it. Suggests they're maybe stopping the bleeding, gaining some relative ground in breakfast and lunch.
So what's driving that stabilization at IHOP? What are they doing operationally?
It seems like the new leadership there is really focused on simplification, cutting complexity.
How so?
Primarily by slashing the number of limited time offers, the LTOs. They cut them by more than half. Simpler menu, easier execution for the kitchen and servers.
Makes sense. Complexity can really bog things down in a restaurant.
Totally. And that simplification, plus they've rolled out server tablets more widely, it's leading to real efficiency gains.
Like what? Did they quantify it?
They did. A 4-minute improvement in average table turns, year to date.
4 minutes? In a high volume place like IHOP, especially during peak hours, that's actually a really big deal for capacity.
It's cold. Absolutely. And they're also tweaking their value strategy,
Okay.
expanding their House Faves value platform. It used to be 5 days a week. They're going to take it to 7 days nationwide later this year.
So doubling down on value there too, but after testing it first?
Right. They said the market tests showed lifts in both traffic and sales. So measured approach there.
Okay, so operational improvements at both brands, Applebee's accelerating, IHOP stabilizing, but it brings us back to that profit miss. Where's the disconnect?
Two big things. Cost friction is one.
Commodities.
Yep. It's a split story again.
Oh.
Applebee's actually saw costs decrease by 8%. Deflation helped them. IHOP got hit hard, an 8% increase year over year, mostly driven by egg and coffee prices being way up.
Ouch. Yeah, you can't streamline your kitchen enough to offset an 8% jump in your main ingredients.
Exactly. And then the other big factor, maybe the bigger one in terms of the market reaction, was the surge in G&A, general and administrative costs.
Right, the corporate overhead. How much did that jump?
Rose to $50.8 million. That's up from $46.9 million last year. And crucially, this wasn't just, normal inflation. Management basically said, we decided to spend this money now.
Okay, that's where the investor anxiety comes in, right?
Right.
Why spend so much now that it tanks the near-term profit number and freaks out the market? Couldn't they phase it in?
Their argument seems to be that the next, say, 3 years are a crucial window. They have to accelerate certain things right now.
Like what specifically? Where did that G&A money go?
Well, some was compensation, professional fees. But the big drivers they called out were ramping up expenses for two key strategic pushes: the newly acquired company-owned restaurants and the big push into dual-brand locations.
Got it. So they're investing heavily in those future growth areas, and that forced them to cut the guidance.
Exactly. That's the trade-off. The full-year adjusted EBITDA guidance got trimmed, down to a range of $220 to $230 million.
From a previous high of $245 million. Okay, that's a noticeable haircut. That's the price of acceleration you mentioned.
And they were pretty upfront about it. They specifically raised the G&A guidance for the year to between $205 and $210 million. And they also bumped up the CapEx guidance capital expenditures to $30 to $40 million.
So connecting the dots. They're prioritizing funding these projects, remodeling stores, converting some to dual brands, staffing up those newly owned stores over protecting the margin in the very near term.
That's the bet. They're gambling that the market will eventually reward them for creating more valuable assets down the road, even if it hurts now.
Okay, speaking of assets, let's talk about those company-owned stores. They operate 70 now across Applebee's, IHOP, Fuzzy's.
Yeah, about 2% of the total system. Not a huge number, but significant strategically.
And the plan isn't just to run them, right? What's the play here? Because owning underperforming stores usually just drags things down.
Right. It's a fix and flip strategy, essentially, but for restaurants. The explicit goal is hold these units for about 3 years.
Okay.
Inject capital, improve the operations dramatically, get them from being bottom-tier performers to solid mid-tier in sales and profit.
And then
this is the key part, refranchise them. Sell them off to strong franchisees, likely at a much better valuation than they could get for them today.
Explain that valuation part. Why is selling them later potentially more valuable than selling them now, even if they fix them up?
It's all about the multiple arbitrage. A company-owned restaurant carries operational risk, labor headaches, repair costs. Wall Street values those earning streams relatively low.
Okay.
But a franchised restaurant, that throws off high-margin, predictable royalty income to the parent company. Pure cash flow. And the market puts a much higher valuation multiple on that predictable royalty stream.
I see. So by fixing the restaurant first, they make it an attractive, profitable asset for a franchisee, and then they capture that higher franchise royalty multiple when they sell it.
That's the thesis. Turn a low multiple operating asset into a high multiple royalty stream.
Makes the short-term spending make more sense if they can pull off the turnaround. But the CFO admitted the profitability in those 70 stores right now is choppy. What's causing the current choppiness?
They pointed to 3 temporary things. One is just basic disruption from construction and remodels. Stores are closed or partly closed.
Makes sense. Number 2.
Investing in people. Staffing up, training existing staff on new procedures for the improved operations, that costs money up front.
Okay, temporary investment. And the 3rd?
This one's interesting. Delays in getting liquor licenses reapplied for and approved for the acquired stores.
Liquor licenses. Seems kind of small, but I guess for Applebee's especially, that's actually a big deal for profit margins, isn't it?
Huge deal. High margin sales. They said only about half the company-owned portfolio currently has its liquor sales active. That's a temporary but significant drag on both revenue and profit per store.
Right. So that should hopefully resolve itself over the next year or so as the paperwork gets done. It's a timing thing, not a fundamental problem with the store itself.
That's how management is framing it, yes. A timing issue.
Okay, so that's the company-owned strategy. What about the other big investment area, the dual brand
Now,
sites?
this seems to be where management sees massive, blue sky potential, combining an Applebee's and an IHOP in one building.
Especially internationally, right? Places like Latin America where they can plant both flags at once.
Exactly. Big white space opportunity there. But even the early domestic results are looking really compelling.
How compelling.
The new dual brand locations they've opened here are apparently doing sales volumes roughly 2 to 3 times higher than what the previous single brand restaurant did in that same spot.
2 to 3 times the sales. Wow. That average unit volume, that AUV lift, is transformative if it holds.
It really is. And it kind of proves the concept, right? IHOP handles breakfast and lunch. Applebee's gets dinner late night. You maximize the use of the building, the staff.
It just makes sense from a utilization standpoint.
And it seems franchisees agree. Management mentioned the pipeline for building new dual brand units is already oversubscribed for 2026.
Oversubscribed. So franchisees are lining up, putting their own money down faster than Dine Brands can even approve them.
That's what it sounds like. That's a pretty strong validation from the people actually writing the checks.
Okay, so you have this potential high multiple refranchising event coming in a few years with the 70 stores, plus this potentially massive growth engine from the high AUV dual brands. That's the long game they're spending for now.
That seems to be exactly the long-term payoff they're aiming for, justifying the current spending bump.
All right, so we've untacked the numbers, the strategies, the spending. Let's pivot to our thought experiment segment. This is not financial advice.
Okay, so the market's immediate reaction, that stock drop, it was clearly all about the near-term margin hit, the G&A bulge, the EBITDA guide down.
Right. The market is basically valuing Dine today like it's just a regular casual dining company facing the usual economic pressures, kind of stuck.
But arguably, that view completely ignores the value creation potential from these two big strategic moves, the dual brand rollout and that refranchising plan for the 70 owned units.
We think there's a potentially deep, undervalued call option embedded in the stock right now, representing that future asset value and cash flow boost. The market's just not pricing it in yet.
So our trade idea is designed to capture that potential re-rating over time while trying to sidestep some of the near-term noise. We pitch a long-dated, out-of-the-money call option on Dine, specifically a LEAP EPS expiring sometime in 2027.
A LEAP PS, okay. Why so far out? Why 2027?
The timing. By 2027, a few things should have happened if management executes. One, a good chunk of those 70 company stores should have been turned around and successfully refranchised at those higher multiples. We'll have proof of concept on the value creation.
Okay, proof point 1.
Two, the dual brand format should have scaled significantly. We'll see if those super high AUVs hold up as they build more, and the market will have recognized that growth potential.
Proof point 2.
Exactly. So by 2027, you could see a fundamental shift in how the market values the entire company, moving from valuing it as an operator to valuing it more like a pure play, high margin franchisor. That transition justifies a much higher valuation multiple.
So the EPS gives you time for that story to play out and potentially get recognized while limiting your upfront capital compared to just buying the stock and riding out the choppiness.
That's the idea. It's a bet that this strategic acceleration plan actually works and the market eventually rewards it, probably within that 24 to 36-month window leading up to 2027.
A bet on strategy trumping the current operational, let's call it, anxiety.
Well put.
Okay, let's quickly recap the main points of our deep dive then. We saw strong top-line results, definitely. Applebee's showing real traffic momentum. IHOP showing signs of operational stabilization.
Yeah, lots of good stuff at the brand level, but completely overshadowed, at least in the market size, by that deliberate investment-driven hike in G&A costs.
Which led directly to the lowered near-term EBITDA guidance. A necessary evil, perhaps, in management's view, to fund that future growth.
Which brings us to the final provocative thought we want to leave you with. It really boils down to the return on investment from these next 3 years of, well, potential pain, or at least lower margins.
Right. Will accelerating the dual brand rollout and fixing and refranchising those 70 stores actually generate enough incremental cash flow, especially that high multiple franchise income, to justify this immediate hit to profitability?
Or has management maybe overinvested, pushing too hard too fast, especially given the somewhat uncertain consumer backdrop? How much better does the business need to look in 3 years to make today's spending worthwhile? Something to mull over.